September 1985, a hotel room in New York City. 5 men from 5 countries sit down at a table, and by the time they stand back up, they have quietly agreed to break the value of the US dollar. No press conference, no warning to markets, just a decision made in an afternoon by people almost nobody watching the news that night could name. It was called the Plaza Accord, and the country it hit hardest was Japan. What happened next took 30 years to finish playing out. A currency that exploded upward, a stock market that tripled, a property bubble so extreme that the land under the Imperial Palace in Tokyo was, on paper, worth more than the entire state of California. And then, when it all came apart, a generation of stagnation so long that economists just started calling it the lost decades. I'm telling you that story first, because 41 years later, almost to the same week in the calendar, the United States and Japan sat down and did it again. And this time, we get to watch it happen in real time. Late July, 2026. A cabinet meeting at Camp David. Cameras are only meant to catch the room, the flags, the handshakes. Instead, a Reuters photographer catches something else entirely, a notepad sitting in front of the US Treasury Secretary, Scott Bessent. On it, 3 lines, underlined, like a grocery list. To do, buy Japanese yen, 5 to 10 billion. That note wasn't a leak. It wasn't a rumor traders were trading on a hunch. It was the actual plan, sitting in plain sight, photographed by accident, time-stamped down to the minute. Within days, it was confirmed. Japan had already spent close to $53 billion in a single day buying up its own currency, the largest one-day currency intervention any country has ever carried out. And then, for the first time since 1998, the United States joined in. Not by selling dollars, by selling euros and using the proceeds to buy yen alongside Tokyo. 2 governments, 2 central banks, one afternoon, working together to save a currency that had just hit its weakest point against the dollar since 1986. Read that last part again, 1986. 1 year after the Plaza Accord was signed, the yen was this weak. Now, 40 years later, it's back there. Whatever got fixed in 1985 came completely undone. So the real question isn't, why did the yen crash? The real question is, why did it take a joint rescue mission from 2 governments to stop it? And why does history seem to be running this same play a second time? To understand why a currency wobble in Tokyo can rattle markets on the other side of the planet, you have to understand a trade that's been running quietly under the floor of the entire global economy for the better part of 2 decades. Here's the plain English version. For years, Japan has kept its interest rates pinned near zero, while everywhere else, the US, Europe, emerging markets, rates sat several points higher. That gap creates an opportunity almost too good to ignore if you're a large fund with the size to exploit it. Step 1, borrow yen for next to nothing. Step 2, convert that yen into dollars, or into whatever currency the higher yielding assets are priced in. Step 3, buy stocks, bonds, real estate, anything paying a real return. Step 4, pocket the spread between what you're paying to borrow and what you're earning to hold. Think of it less like a loan and more like a rented boat. As long as the water stays calm, as long as the yen stays weak and Japanese rates stay low, you can keep that boat out indefinitely and just keep collecting fish. The moment the water gets choppy, though, the owner of the boat wants it back immediately, in whatever condition it's in, and you have to scramble to return it before you're the one left underwater. A stronger yen is choppy water. It means the loan you took out is now more expensive to repay in whatever currency you're holding. Lenders don't wait patiently when that happens. They call the loan back. And when a loan that size gets called back all at once, the fastest way to raise cash isn't to sell the illiquid stuff. It's to sell whatever can be sold in seconds. That usually means the most liquid, most widely held assets on earth, US stocks. That's the mechanical link between the yen went up a little and American markets suddenly got shaky. Nobody sold Apple or Microsoft because they stopped believing in the companies. They sold because somewhere upstream, a very large, very leveraged bet on a weak yen just stopped making sense. Here's the part almost nobody explains clearly, and it has nothing to do with currency trading and everything to do with debt. Japan is the single largest foreign holder of United States government debt on the planet, over $1 trillion worth of US treasuries sitting on its books. When Tokyo needs firepower to defend a collapsing yen, one of its biggest available sources of cash is exactly that pile of treasuries, so follow the chain all the way through. A weak yen forces Japan to sell US debt to fund its defense of the currency. A major seller entering the treasury market pushes bond prices down and yields up. Higher yields mean it costs the US government more to service its own debt. Debt that's already sitting close to $40 trillion, with annual interest payments that have themselves crossed the $1 trillion mark. And higher yields don't stay contained to government bonds. They flow straight into mortgage rates, car loans, and corporate borrowing costs for everyone else. Washington didn't jump into the yen market out of loyalty to an old ally. It jumped in because a Japanese currency crisis was on a direct pipeline to becoming an American interest rate crisis. The intervention wasn't generosity. It was self-defense, dressed up as diplomacy. Now, here's where I want to slow down, because this is the part most coverage got lazy about. In the same stretch of weeks, South Korea's stock market had the single worst month in its recorded history. A drop north of 20%, deeper than the 2008 financial crisis, deeper than the 1997 Asian financial crisis that reshaped the entire region. Circuit breakers, the automatic trading halts designed to stop a market from free falling, were triggered more times in a matter of weeks than in most entire years combined. It's tempting to draw a straight line from yen intervention to Korea crashes and call it one tidy story. But that's not quite honest. The real trigger in Korea was something else. A runaway bet on AI and semiconductor stocks, built on record levels of borrowed money from retail traders. Samsung and SK Hynix had rocketed to historic valuations on the promise of the AI boom. Reports that China had begun mass-producing its own advanced chip-making equipment, followed by a disappointing earnings report from SK Hynix, was enough to puncture that story. Once it popped, the leverage stacked underneath it did the rest. Forced selling feeding more forced selling. So Korea wasn't crushed by the yen. Korea was crushed by the same underlying disease the yen carry trade represents, just wearing a different costume. Cheap, borrowed money, piled into a narrative everyone agreed was unstoppable, right up until it wasn't. That's the actual through line connecting Tokyo, Washington, and Seoul in the summer of 2026. Not one single trade gone wrong, a pattern, showing up in 3 different markets at once, because the ingredients: easy leverage, a crowded consensus trade, and a shock nobody priced in, are sitting underneath more corners of this global economy than most people realize. Go back to 1985 one more time. After the Plaza Accord strengthened the yen, Japan's central bank slashed interest rates to cushion its exporters from the shock. That flood of cheap money didn't just sit still. It poured into Japanese stocks and Japanese real estate, inflating both into one of the largest asset bubbles the modern world has ever recorded. When it finally burst in 1990, it didn't just cost investors money. It cost Japan an entire generation of economic growth. Nobody is saying 2026 is a perfect rerun of 1985. Different debt levels, different central banks, an AI boom instead of a real estate boom, a joint intervention instead of a 5-country accord. But the shape of the lesson rhymes uncomfortably well. Currency interventions don't end problems, they relocate them. Cheap money doesn't disappear when a headline changes, it just goes looking for a new place to inflate. And the investors who get hurt worst are rarely the ones who built the trade. They're the ones who showed up late, leveraged, believing the story had no ending. So here's where that leaves you, watching this from wherever you are, with money in the market or thinking about putting some in. You don't need to predict the next 40 minutes of trading. You need to understand the shape of the pattern well enough to recognize it before it's your portfolio it's happening to. Watch for crowded trades everyone agrees are obviously going to keep working. Watch for leverage quietly stacking underneath a story that sounds too clean. And remember that when governments step into a market this aggressively, it's rarely because everything is fine. It's usually because they're trying to buy time for something bigger to unwind slowly instead of all at once. In 1985, it took 30 years for the full bill to come due. Nobody watching that Plaza Hotel meeting on the evening news had any idea what they'd just watched. This time, the meeting got photographed by accident. We don't have that excuse.